Good afternoon, everyone. Before we get started, I'd like all my panelists to have a little chance to talk a little bit about it themselves and what they do at their firms. Don, why don't you start us off?
Yeah, Don Thornton with DAT Solutions. We're based out of Portland, Oregon. We're the old dinosaur here at the show. We've been around for 41 years. We were here when deregulation happened back in the late 70s. And we've been keeping up with the technology, and I'm really happy that you invited me, Addison. Thank you.
Thank you. Danny Gomez?
I'm Danny Gomez with Nodal Exchange. I joined the exchange back before we launched in 2008. I helped them launch a futures exchange in the power space and then later a clearinghouse, and was part of the group that first received Craig when he came to talk about freight futures. So happy to be here at a post-launch date.
And Patrick?
I'm Patrick Trout. I am a principal member at K-Ratio, a CFTC member firm, CTA located out of Chicago.
All right, thanks. So we're here to talk about the newly launched freight futures contract, which began trading at the end of March. And as a means to hedge spot market dry van rate volatility, I think we have a very strong feeling that there are financial contracts whose time has come, and we often get the question when we're out at road shows or even here, why now? You know, this is a market that's been around for a long time. It hasn't been intermediated by a financial contract before now. So what is different now? What are some of the factors that have led to this contract being launched now? And I'm gonna turn to Don first. As he said, he comes from a dinosaur firm. He's a real veteran of the industry. He's seen a lot of different things happen over the years. So how would you approach that question, Don? Like, what have you seen, having been in the market for so long? What's different now than it was 5, 10, 15 years ago?
Well, there's been a technology evolution in our space, Addison, and it's been going on for a long time. We tried our first mobile app in probably 2006, 2007 time frame. It was a bomb. The marketplace wasn't ready for it. As you know, dial-a-truck is what DAT stands for, and so we have this history of different technologies that have been used in our marketplace. As far as technology evolution, the mobile phone has changed everything for our customers. It's easier to access drivers than ever before. There have been other technologies with data science that's been introduced to all our companies, and so our ability to access data, develop algorithms, change the way companies see and hear about what's going on in the marketplace has changed. DAT started collecting rates back in the early 2000s. We were buying it from companies, and then we determined that in about 2010, it made more sense to start collecting the information ourselves. And so we've gone to our customers, carriers, brokers, and shippers, and we've been doing that for about 10 years now. And we've got really great information, better information than we've ever had about what's going on in the marketplace. That's really helped a lot. There's also a bunch of market forces that have changed. And one of the major market forces is the ELD mandate. When the ELD mandate hit, it was a perfect storm in our industry in terms of impacting the labor shortages that we had for drivers in the marketplace. And that also had a major impact on our industry.
Thanks. And Danny, from your perspective, I mean, again, this is a product that's never existed in a futures market before. You're a veteran of futures markets. You've seen contracts come and go. What was it about trucking freight futures and the approach that FreightWaves brought to you that made it seem like this was something that the Nodal Exchange wanted to get involved with?
Sure. Yeah. So, the first question we asked ourselves is, what problem is it solving, right? And as we started to learn more about the trucking industry and the size of it, and the fact that there was no risk management tool in place, or had historically ever been in place, in a market that was much bigger than the energy markets that we were dealing in, who were effectively using futures markets, that there was no risk management tool to hedge against the spot rates. And so that's the biggest thing, right? Is there a problem you're solving? And then when we started to examine to see if the market itself had the characteristics of what a successful futures market could be, it's the size is there, the volatility is there, you have natural buyers and sellers, you have a spot market that's thriving. You also have, when we talked to FreightWaves or Craig at the time he came in, and we started talking through what this could look like, there were some early questions on whether or not they would launch an exchange. We said, don't do that, we've done it before, we wouldn't recommend going down that path. And so talking about having them listed with us and having FreightWaves focus on the sales and marketing, we obviously don't have a background in trucking, and when you're trying to introduce a new contract into the market, you really need people who are trusted in the space to be talking about the effectiveness of the contract, why it should be used, and really have lived, on whether it's the shipper, the carrier, the 3PL side, to talk to the problems that they're facing and how this contract itself can be used. So when we looked at all of those together, it really had the perfect makeup for what a futures market can be. And I think it speaks to the reception we got when we went out and talked to all the banks. So in the exchange world, you have the clearinghouse that all the banks are members of, and then you have the exchange that all participants are members of. When we went to go talk to the banks, the ones who at the end of the day guarantee the business, every industry veteran that we spoke to, their eyes just lit up. I think we had the benefit of coming behind Bitcoin because that seemed like something that was just hard, intangible to really think about,
right.
A market that people weren't familiar with. But when we started talking about trucking and about the size of the market, and you were at that time on the other side of the table,
right.
And obviously it spoke to you as well to come to FreightWaves and to be part of it. And so it's really the reception we got from the industry, it made us more confident that we were going down the right path with FreightWaves.
Great, great. So in development of a market, in a futures market, of course you have to have a benchmark. You have to have a really strong index. And that's where obviously that comes in. Don, you touched on it a little bit early in the first answer, but can you talk a little bit more about the development of the indices that went into becoming attached to the futures contracts?
Well, we have a product today called RateView that we have about 50,000 users on that system today that either work as a broker, trucking company, or a shipper. And that tool is used so that companies could benchmark what they're doing in a specific lane. We've got 18,000 lanes for vans, flats, and reavers. When Craig first came to me and said, hey, we've got this opportunity to develop a futures market, we spent a lot of time and we agreed that it made sense to have a cash-based, a financial-based transaction that would be used instead of having a truck involved in it. And so we were very interested in doing it as long as it didn't involve trucks. It didn't involve that a broker had to get involved as far as the transaction or a shipper. And so we spent a lot of time with Craig and their data science team, teamed up with our data science team, and we spent time looking at what lanes were uniquely correlated to get the largest capture of lanes that would make sense. And we started out and got to 7 lanes as the initial lanes for the indices. We published that on a daily basis and developed the algorithms to create that one-day lane rate, and we update it daily. And then we've worked with companies like Pat to provide information so they can make informed decisions about how do they want to use that information.
And Danny, what is, sorry Pat, I'm not ignoring you, I'll get to you in a second.
No problem.
So Danny, for the audience, can you explain a little bit, again, because futures is a new concept to many people
Sure.
here. Can you talk a little bit, so obviously the indices are really important, but when you go to develop a futures contract, talk about, the link and why that's so critical.
Sure. Take an example of, say you traded next January 2020, right? And so you're going to trade that at a futures price. All of the transactions that we get through the exchange, whether it's information through the screen, whether it's market intelligence that we get or actual trades that are transacted on the screen, shape the forward curve, which is the futures price, right? And so there's as the market is participating in the futures, they're informing the exchange on what the market's view is of the future price of any of the lanes. And so say, for instance, say the national average, the national index for next January trades at $1.75. Every day, the exchange is updating their view of what the market will be in the future. And so that move, so say if some news comes in and the market feels like the rates are going to be going up in January, then the futures market will reflect the market's view of the prices rising. And that continues to go all the way until we get into January of next year. Once we get into January of next year, then we have real spot data from DAT to tell us where the futures market actually settled out at. So you have the futures prices, which is the curve, the forward view of the market that continues to operate until you get inside the month. And then it becomes a gradual mix of data. So on the first day or the fifth day, you only have, because we have the lag, right? On the fifth day, you have the first day of data from DAT, and then the second day, and then so you start to build a clearer picture of what January is going to settle out at. And so people can trade futures and hold it all the way until expiration. And at the end of expiration, if they traded it at, say, $1.75 and it settles out at $1.80, then there's a 5-cent differential. And depending on what side of where they're long or short, that's either a gain or a loss relative to their position.
Okay. Thank you. So, Pat, so we've got price transparency through the futures market. And we've got the DAT, the data indices. So what are you're going out and you're talking to the industry, right? You're talking to shippers and you're talking to carriers. What are you telling them about how these contracts can be used in their business?
Yeah, great question, and comes up early and often is shippers, carriers, and 3PLs. When we're out there, they say, okay, great, there's 7 tradable lanes, 4 aggregates, but how does that necessarily tie into my underlying book of business? And so when you take a look, you have Seattle to LA, LA back to Seattle, LA to Dallas, Dallas to LA, over in the west and the south. Over in the east, you have Chicago to Atlanta, Atlanta to Philly, and then Philly back to Chicago. Additionally, you have the aggregates as well as the national composite. But what happens when you have a book of business that runs 500 times Madison to Tallahassee? Now, in an instance like that, when you take a look at it, you're generally going to find that that's going to look a whole lot like Chicago to Atlanta. Or if you're running Richmond to Ames, that's probably going to look a lot like Philadelphia to Chicago. But what happens when you're running Buffalo to, let's say, Omaha? You may need to get your hands dirty a little bit and kind of back into those lanes and say, okay, that's 2 parts Philadelphia to Chicago and 1 part Chicago to Atlanta, and that's how you're going to have your correlation. But then additionally, you have the seasonality to the industry, and when you have that type of seasonality, you could kind of run into some trouble if you're not monitoring these correlations continually, and that's something that we're constantly working with Don and the DAT to make sure that people have insight into these correlations breaking down. So I could assure you that if you had a correlation that was working for you that involved, Seattle, or Seattle to LA, or LA to Seattle, that's probably going to break down during Christmas tree season. Same thing could go for the produce season down in the southeast. You're going to have Chicago, your Chicago to Atlanta. Your correlations are probably going to be compromised during the late spring, early summer.
So it sounds like the information is there, and that you've figured out a way to make this work. Is it a hard? You've just done a good job of explaining it. I mean, do you find it? Is there a receptive audience right now? I mean, are the companies coming to you and saying, look, we need to figure this out? Is it a heavy lift? What can you do to help us figure this out? Yeah, and that's exactly why we're here. We have traders, we have quants, and we work with 3PLs. That is a small book of business that's $50 million, and then we're also in talks with large enterprise shippers that have $50 billion of top line revenue, and 10% of that
inside of a shipping spend.
Right. Now, Pat, I'll stick with you for a minute here. As we know, the carrier world is highly fragmented, and a majority of truckers work for small, independent companies. How are they coming to you and asking how they can get involved in the trucking freight futures market?
Yes, surprisingly, those are the ones chomping at the bit the most. Kind of knocking down that door, saying, "Hey, we want to get trading." And but the nodal exchange, correct me if I'm wrong here, Danny, but has 1 million in cash or cash equivalents or 10 million in assets to become a member of the nodal exchange. So that creates somewhat of a barrier of entry, but that barrier of entry is kind of required in order to make sure there's legitimacy inside of the marketplace. So what we start to do is we start to sit there and say, okay, how can we develop possibly a fund that would allow, many other markets have these co-ops or funds that enable the smaller players to sit there and not necessarily trade on their direct book of business, but have some protection on macro trades. So for instance, a carrier fund, when rates were inflated, the fund manager would probably initiate some short positions.
Right. And Danny, what are the initiatives that Nodal is working on to help expand access to the marketplace?
Sure.
I mean, right now there seems to be a couple of small impediments that need to be worked through. Can you talk a little bit about how we're all working to try and expand the universe of available participants?
Yeah, absolutely. So, I mean, in the power space, there's a term that may not mean much to anyone in the room, but we, in the exchange industry, call it intermediation. And so in the power space, it's really not a key factor for exchange participants to have intermediation. It is in some capacity, but it's not a big portion of the market. We, even before moving into freight, saw a need for us to mature as an exchange and clearinghouse and offer more access to smaller participants. And so we've started a project, and we've been working on a project to allow for that type of membership. So for people who can work through, omnibus accounts or different account structures who don't have the financial requirements can also get access to the exchange in the easier fashion. And so that's something that we're currently working on. Timing, I won't give a date because my developers would kill me. But in the near future, we'll have more access. And I think, kind of what you guys are working on, we see in the power space as well, in the energy space, where there's a couple of different things. There's ways of aggregating a lot of different needs for hedging, and to using those aggregated needs to create trading positions. As well, there's also the capacity for CTAs that we had talked about before, where in the trucking world, I think it's fair to say that there is a large group of people who have never traded futures contracts before in their life, and so there's a big learning curve there, and CTAs, K ratio can do a lot in helping people understand what the hedging strategy should be, right? Understanding your book of business, your mix of business, and then helping you interface with clearing members and being a member of the exchange. So I think there's two bits there. There's the people who can be members of the exchange, but who historically have never traded on an exchange, who need a service. And then there's also the people who may not qualify for the exchange, so in the future they'll have better access.
So far we've really been focused on the industry and how the industry can access trading the futures market. But as we know, for any successful futures market to develop, there also has to be an aspect of financial traders being involved. So can you talk a bit about the role of banks generally in hedge funds and commodity trade? We've used the term CTA. I'm sure many in this audience don't understand what that means.
Yeah.
It means commodity trading advisor. And then the hedge funds.
Sure.
Talk a little bit about how they will eventually interact with this market, what you've seen in the past, and how that grows, and then what develops when you've got both industry and the financial markets working together to build the liquidity.
Sure. Yeah, I think, just breaking up, just generically speaking, you can break up the participants in two categories, the physical players and the financial players. And in the financial, like you mentioned, there's banks, there's hedge funds. And I think there's a misconception that people who don't have physical exposure are you know, purely speculating or not necessarily providing great hedging counterparties.
The S word.
Yes.
The S word.
Speculating.
Right.
But the reality is banks are providing a service, right? You're transferring your risk from yourself to somebody who's willing to take that risk. The great thing about a futures exchange is that you don't care who the other side is, because nodal exchange and nodal clear are standing in the middle. So they're the buyer to every seller, the seller to every buyer. So what that does a couple things. One, it increases the liquidity pool for you, so you have more people you can transact with. In a bilateral market, you can only trade with people who you trust and who you have paper with. In a futures market, you can trade with anybody who's on the exchange. And so the banks can come in and they can provide a service to any of the financial players in providing liquidity to the market, in that they're willing to wear that risk. And so if a big shipper or carrier wants to go lay off that risk in a futures exchange, they have counterparties there to do it. Not only do they have the banks, but in a really healthy market, you have a good mix of physical buyers and sellers, which is one of the things that we really liked about this, right? There was natural buyers and sellers. And then in trucking, you have kind of the added dimension where you have the 3PLs who really do feel a lot like commodities traders, right? I mean, I have yet to be to a floor yet, but I see pictures of all the 3PL floors, and they look like trading desks, right?
Yep.
And so they're already playing kind of a liquidity provider in the market, right? They're aggregating the carriers and providing shipping to the shippers. And so I think that over time, the market will need to be founded, the backbone of the market will be founded on the physical players, and having them come and seeing the value. And then the financial players, they don't want to trade against themselves. We've seen markets that have failed like that. It's just financial players trading with each other, and that doesn't last very long.
Right.
And so the physical players will, I think, start the market. The financial players will see the opportunity to come in and provide hedging opportunities, and for them, they generate commissions and fees off of the things that they do. And so it becomes a really healthy market. I mean, if you look at the maturation of futures exchange, I think the good ones start off with a very physical, a lot of physical players there to provide liquidity, and then that attracts the financial community, and the financial community starts to come in force. And for our market, it's probably 60-40. But if you look at some of the more, you talk about the multiple markets, you talk about the oil market,
right?
And that's probably, I don't know,
20-1 probably.
Yeah, that's my guess as well. So, the market will change over time, but I think at the beginning it's really healthy to have the physical players supporting the market and understanding, what they're getting by putting these hedges on, and that, there's no winners in a well-placed hedge. There's not winners and losers. Everybody is, walking away that hopefully that the banks price it correctly, and that they're not, financially hurt, and then that the hedgers feel like they got the hedge that they wanted, right? And in some situations that may, providing them stability in either, the costs that they're getting or the revenues that they're receiving.
Right. So, the contract's only been trading for a little, like 6 weeks, right? And all of us have had feedback, right, from players in the marketplace about the different specifications in the contract. I mean, right now, we're building liquidity. We're trying to make it bigger. I mean, what are some of the things, Don? Have you heard from anyone about how? What should we be thinking about next with these contracts? Should we be thinking about the reefer market? Should we be thinking about maybe a larger sized contract than just 1,000 miles? Should perhaps we be thinking about a different duration than a month? Should we be, because it is a physical index, have you had any conversation about trying to relate the futures price more closely to what is happening in the day? So like a weekly market or a balance of the month market?
I think that there's definitely interest from what I hear from companies that would be interested in different time frames than what we've set initially. I think everyone would like to forecast out a year and understand what's going to happen in the marketplace and take a position. I think weekly makes a lot of sense. The market changes a lot. I mean, if you've been in this market for the last 20 years, we've had several huge fluctuations in market supply and demand. And I think that's going to continue.
Right. Last year there were weeks when the market, in some markets, moved 20% within inside of a week.
And right now, we're just starting the spring. We're starting the spring, and we're starting to see things pick up, and you're going to start seeing rates change, and you're going to have this normal, cyclical cycle of the summer and the late spring, and you're going to see rates change, and you're going to see differences in supply and demand. So I think as long as we can be understanding what the market needs are in terms of taking these positions and understanding the risk of what they're looking for. I think the van market's a great market because it's the biggest market out there. Right. It's 70% of what we see in terms of transportation, and it affects others. I could see the refrigerated market coming in maybe second, when there's a need for that. But I think you could also use some of the data that we have today and understand what happens in those markets with existing information. So,
how about you, Pat? Have you heard anything from the participants you've been speaking to?
Yeah, and to kind of follow up with what Don was saying there, it's probably going to take one exogenous event, whether it be a hurricane, whether it be a geopolitical event, that, right now, it could not be a better time for a shipper to jump into this market. Rates are depressed right now, and the forward curve is looking pretty flat. I think there's maybe 14 cents. 14-cent delta, at its highest point. So, the shipper is sitting at a pretty good place right now. However, you get that exogenous event, like a hurricane, come September, and all of a sudden, rates jump up 50, 60 cents. They're going to be sitting there asking themselves, why don't I have this protection? And I think that's another thing that we, really need to think is that getting into this marketplace is the less risky behavior. Jumping into this marketplace is not where the risk happens. It's not participating in it. And I think once that, once that philosophy kind of kicks in amongst the shippers, carriers, and 3PLs, we're going to see that gradual liquidity. And then once the pool's full, it's going to be a thriving marketplace for everybody.
Right. Not hedging is the risk.
That's exactly right.
Which is a truism in any futures market. Danny, just to, we only have a couple minutes left. I mean, what about you? I mean, are there ideas that you've heard out there? Again, we're all heavily invested in making sure, we've got all the partners here, we're heavily invested in making sure this works. In my experience in the futures market, the contracts that are launched and survive are ones that have some adaptability. The exchange and the people who are bringing the contract, they listen to the people out here in the audience, and they respond. So where do you think that's going to go with this contract?
Yeah, I mean, I think the good news is we've already heard some feedback. Even through the road shows, there's a lot of feedback from people who are attending. We want to hear more feedback from people who are trading, right? You really start to understand the product when you start to put the trades on and you start to run through the process. We've already heard about shorter term contracts that Don was saying, so weekly term contracts that make a lot of sense. We actually thought that was a debate early on, but it's, how do we focus liquidity? Options could be coming down the road, other reefer type of vans, so other type of vans. So I think the good news is we're already hearing feedback, and I think we'll continue to hear more. And to your point, being responsive is how we'll continue to build trust. And so I think we're all vested in doing that.
Don, Danny, Pat, thank you all very much for your time. Thank you.